In this video, we're breaking down 3 high-conviction stocks that could be setting up for a powerful rebound while also having the kind of long-term business quality that makes them worth holding for years, not just months. These are businesses with durable competitive advantages, strong market positions, and catalysts that could reward patient investors as the second half of the year unfolds. One of the biggest investing mistakes people make is assuming that exciting companies are always the ones making headlines. In reality, some of the best long-term investments are quietly building technologies that entire industries depend on every single day. Let's start with the first company, because it may also be the one the market is still underestimating. That brings us to Trimble, ticker symbol TRMB. At first glance, Trimble doesn't look like a flashy technology company. It isn't competing for consumer attention or releasing viral gadgets. Instead, it operates behind the scenes, helping connect the physical world with the digital world through specialized hardware, software, and services. And that business model is exactly why so many Wall Street analysts continue to believe the stock has meaningful upside. Trimble has become an essential technology partner across several industries, with construction representing its largest opportunity. Its products help architects design projects in 3 dimensions before construction even begins. Contractors use its software to manage projects, reduce costly mistakes, improve scheduling, and increase productivity. Digital fabrication tools help transform computer models into real-world construction with remarkable precision. But construction is only part of the story. Trimble also serves agriculture, utilities, forestry, geospatial mapping, and transportation. Across these industries, the company's mission remains consistent: use data, software, and automation to eliminate waste, improve efficiency, and help customers make smarter decisions. That may sound simple, but the economic value is enormous. When construction projects run behind schedule, costs can explode. When farms waste resources, profitability falls. When utility companies struggle with infrastructure management, expenses increase rapidly. Trimble's technology addresses these problems directly, making it far more valuable than a simple software subscription. One reason investors have become increasingly optimistic is the company's ongoing transformation. Historically, Trimble generated significant revenue from hardware sales. Hardware businesses can be cyclical because customers purchase equipment periodically rather than continuously. Management has spent years changing that model. Instead of relying primarily on one-time hardware sales, Trimble has been expanding recurring software subscriptions and services. Subscription revenue tends to produce more predictable cash flow, higher profit margins, and stronger customer relationships. Investors generally reward businesses that successfully transition toward recurring revenue because earnings become more stable and easier to forecast. That transformation has not always been smooth. Some investors have struggled to understand the company's evolving business mix. Different operating segments have moved at different speeds, making financial results appear more complicated than many technology companies. Ironically, that complexity may have created opportunity. Rather than chasing short-term excitement, management has continued executing its long-term strategy, steadily integrating hardware, software, cloud services, and artificial intelligence into comprehensive workflow solutions. Analysts appear increasingly confident that this strategy is beginning to pay off. One particularly encouraging development involves artificial intelligence. Unlike companies that simply mention AI during earnings calls to excite investors, Trimble has identified practical ways to monetize the technology. Management has discussed a multi-layered AI strategy where artificial intelligence enhances existing software while also becoming a standalone product offering in certain situations. That distinction matters. If AI only improves existing software, customers receive better products and retention improves. If AI also creates entirely new revenue streams, the company's long-term earnings potential expands even further. That's one reason analysts remain optimistic despite near-term uncertainty in several end markets. Another important factor is the broader digitization trend happening across construction and industrial businesses. Construction has historically lagged many industries in digital transformation. Many processes remained manual for decades, creating inefficiencies that cost billions of dollars every year. Today, companies are increasingly investing in connected workflows, digital twins, automation, real-time project management, and integrated data systems. Trimble sits directly in the middle of that transformation. Instead of selling isolated products, it increasingly offers integrated ecosystems that help customers manage entire projects from planning through execution. That creates switching costs. Once customers build their operations around Trimble's software ecosystem, changing providers becomes disruptive, expensive, and risky. Strong switching costs often become one of the most valuable competitive advantages any software business can possess. Another development investors should watch closely involves the company's transportation business. Reports have indicated that Trimble has explored selling this division. If that ultimately happens, management could sharpen its focus around higher growth, higher margin businesses while potentially unlocking additional shareholder value. Markets frequently reward companies that simplify operations and concentrate resources on their strongest competitive advantages. Meanwhile, the core construction and geospatial businesses continue benefiting from long-term structural demand rather than temporary economic trends. Even during periods when construction activity slows, the need for greater efficiency never disappears. If anything, difficult environments often encourage companies to adopt productivity-enhancing technologies faster because reducing costs becomes even more important. That creates an interesting dynamic for Trimble. Its customers may delay certain purchases during economic uncertainty, but the long-term need for digitization continues moving forward. Analyst sentiment reflects that confidence. Currently, Trimble carries an impressive consensus of 13 buy ratings with 0 hold ratings and 0 sell ratings. That kind of unanimous support is relatively uncommon. The bullish thesis centers around several important themes. First, analysts believe the company's recent complexity has temporarily weighed on investor sentiment. Second, they expect continued upward revisions to earnings estimates as execution improves. Third, they see expanding recurring software revenue supporting higher margins over time. Fourth, they believe AI monetization represents an additional growth driver that the market may not be fully appreciating yet. Finally, they expect Trimble to continue outperforming peers by leveraging integrated, data-driven workflow solutions across multiple industries. When you step back and look at the bigger picture, Trimble isn't simply selling software. It is becoming digital infrastructure for industries that are only beginning their technology transformation. That distinction is important because infrastructure businesses often enjoy decades of relevance. As construction projects become increasingly connected, as automation expands, and as companies rely more heavily on real-time operational data, businesses like Trimble become even more deeply embedded within customer operations. That creates the possibility of long-lasting compounding rather than temporary growth. Of course, no investment comes without risks. Construction spending can fluctuate alongside the economy. Industrial markets can experience periods of slower demand. Execution during large business transformations is never guaranteed. Investors should also recognize that valuation still matters, even for excellent businesses. However, the qualities that make Trimble attractive remain difficult to ignore. It operates in industries undergoing secular digital transformation. It is steadily increasing recurring revenue. Artificial intelligence creates additional monetization opportunities. Its integrated platform strengthens customer loyalty, and Wall Street analysts remain overwhelmingly optimistic about the company's long-term prospects. For investors searching beyond the obvious technology giants, Trimble represents an interesting combination of industrial exposure and software economics. Those are exactly the types of businesses that often surprise investors over long holding periods because they quietly compound value while attracting relatively little attention. Sometimes the market's biggest winners are not the companies everyone talks about today. They're the businesses building the digital foundations that entire industries will rely on tomorrow. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second rebound opportunity operates in a completely different industry, but it shares one important characteristic with Trimble. That company is Wynn Resorts, ticker symbol WYNN. When most people hear the word casino, they immediately think about gambling, but that perspective misses what Wynn has spent decades building. Wynn is not simply a casino operator, it is a luxury hospitality company that happens to include casinos as part of a much larger entertainment ecosystem. Its flagship properties combine luxury hotels, fine dining, convention space, high-end retail shopping, spas, nightlife, beach clubs, entertainment venues, and premium gaming experiences that attract some of the highest spending customers anywhere in the world. That business model creates a significant competitive advantage. Affluent travelers behave differently from average consumers. While economic slowdowns can reduce discretionary spending for many households, wealthier customers often continue traveling, dining, attending conferences, and visiting premium resorts. That makes Wynn's customer base considerably more resilient than many investors assume. Its portfolio includes some of the most recognizable luxury resort properties in the industry. The company owns and operates Wynn Las Vegas, Wynn Macau, Wynn Palace Cotai, Wynn Mayfair, and Encore Boston Harbor. Each property targets premium customers who are seeking an experience rather than simply a place to stay. That distinction matters because premium experiences typically support stronger pricing power. Luxury travelers are often less sensitive to room rates, restaurant pricing, entertainment costs, and premium services than the average consumer. That allows Wynn to generate attractive revenue across multiple segments instead of relying solely on casino gaming. In fact, every guest represents several potential revenue opportunities. Someone may book a luxury suite, dine at multiple restaurants, visit the spa, attend entertainment events, shop at high-end retailers, and spend time in the casino. Each additional experience increases customer value while maximizing the return on Wynn's world-class real estate. But perhaps the most exciting part of the investment story is not where Wynn operates today. It is where it is expanding next. One of the company's biggest long-term growth catalysts is its integrated resort currently under development in Ras Al Khaimah, United Arab Emirates, which is expected to open in 2027. This project has attracted enormous attention because it represents much more than simply another hotel. It positions Wynn inside one of the world's fastest-growing luxury tourism regions. The UAE has spent years investing billions of dollars into becoming a global destination for tourism, entertainment, international business, and luxury experiences. As infrastructure expands and visitor numbers continue growing, Wynn could find itself operating one of the region's premier integrated resorts. Many analysts believe this project alone could create substantial shareholder value. Some estimates suggest the UAE development could eventually contribute as much as $50 per share in incremental value through management fees and Wynn's ownership interest. For perspective, that's a remarkably meaningful figure relative to the company's stock price and illustrates why investors remain so interested in this expansion. The project also diversifies Wynn geographically. Rather than relying exclusively on Las Vegas and Macau, management is adding another premium destination capable of generating cash flow for decades. Diversification like this becomes especially valuable during periods when individual regions experience temporary economic weakness. Speaking of Macau, that market continues to recover after several years of extraordinary disruption. Tourism activity has steadily improved as travel restrictions have faded and premium gaming demand has continued normalizing. Importantly, Wynn maintains a particularly strong position within Macau's premium mass market. This customer segment has become increasingly important because it tends to generate healthier and more sustainable profitability than the older junket-driven business model. Analysts expect continued recovery as visitation trends improve and capacity expands. There are also plans for an additional hotel tower that could further increase Wynn's ability to accommodate premium guests in Macau over time. Meanwhile, Las Vegas continues demonstrating why it remains one of the world's most resilient entertainment destinations. Despite periodic concerns about consumer spending, the highest end of the Las Vegas market has remained surprisingly durable. Luxury travelers continue booking premium accommodations, attending conventions, dining at upscale restaurants, and spending on entertainment. That strength plays directly into Wynn's positioning. Because the company intentionally focuses on affluent customers, it has generally experienced less pressure than operators targeting more budget-conscious travelers. Another encouraging trend involves free cash flow. As large development spending eventually declines following completion of the UAE project, analysts expect free cash flow generation to accelerate. That opens several possibilities. Management could increase shareholder returns through higher dividends. It could authorize additional share repurchases. It could reduce leverage even further. Or it could pursue additional growth investments while maintaining financial flexibility. Companies that consistently generate growing free cash flow often create multiple paths for long-term shareholder value creation. Analyst sentiment toward Wynn remains remarkably positive. The company currently carries 19 buy ratings with 0 hold ratings and 0 sell ratings. That unanimous optimism reflects confidence in several key drivers. Analysts believe Wynn's affluent customer base provides resilience during softer economic environments. They expect Macau's ongoing recovery to continue supporting earnings growth. They see the UAE resort as one of the most attractive long-term catalysts in the hospitality industry, and they anticipate declining leverage alongside improving free cash flow after the UAE opening. When all of those factors are considered together, the long-term investment case becomes much easier to understand. Wynn is not depending on one single catalyst. It has multiple growth engines operating simultaneously. Las Vegas continues serving premium travelers. Macau continues recovering. The UAE expansion creates an entirely new growth platform, and improving cash generation strengthens shareholder return potential. Of course, investors should also recognize the risks. Travel demand can fluctuate. Consumer confidence affects discretionary spending. Gaming revenue can experience short-term volatility. Large development projects always involve execution risk and substantial capital investment, but those risks are balanced by premium assets that competitors simply cannot recreate overnight. Luxury integrated resorts require enormous amounts of capital, years of planning, regulatory approvals, world-class management, and globally recognized brands. Those barriers to entry help protect Wynn's competitive position for years into the future. Long-term investing often comes down to owning scarce assets that continue increasing in value over time. Whether it's prime real estate, premium brands, or irreplaceable customer relationships, scarcity frequently creates pricing power. Wynn owns all three. Its resorts occupy some of the most desirable locations in global tourism. Its brand remains synonymous with luxury hospitality, and its loyal customer base continues returning for premium experiences that competitors struggle to match. If global tourism continues expanding over the next decade, Wynn appears well-positioned to benefit from that trend, while also creating additional shareholder value through disciplined capital allocation and strategic expansion. For investors looking beyond technology and searching for exposure to premium consumer spending, luxury travel, and long-term tourism growth, Wynn Resorts presents a compelling rebound opportunity that could continue rewarding shareholders well beyond the current market cycle. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our final stock may also be the safest name on this list, but don't mistake safety for a lack of opportunity. That company is Microsoft, ticker MSFT. There are very few businesses on the planet that touch as many people, industries, and organizations as Microsoft. Whether you're working from home, managing a Fortune 500 company, collaborating with coworkers, storing data in the cloud, building software, gaming, or increasingly using artificial intelligence to improve productivity, there's a good chance Microsoft is involved somewhere behind the scenes. That breadth is incredibly difficult to replicate. Many technology companies dominate one market. Microsoft dominates several. Windows remains one of the world's most widely used operating systems. Microsoft Office continues serving hundreds of millions of users across businesses, schools, and governments. Azure has become one of the largest cloud computing platforms globally. The company also owns Xbox, LinkedIn, GitHub, enterprise security solutions, business intelligence software, developer tools, and one of the deepest enterprise software ecosystems ever assembled. Each of these businesses strengthens the others. That interconnected ecosystem creates one of Microsoft's greatest competitive advantages. When a business uses Microsoft Teams for communication, Office for productivity, Azure for cloud infrastructure, Power BI for analytics, and Microsoft's security platform to protect its network, switching providers becomes incredibly disruptive. Replacing one product is difficult. Replacing an entire technology ecosystem is another challenge altogether. Those high switching costs help explain why Microsoft's customer relationships often last for decades. This is one of the reasons investors consistently view Microsoft as a long-term compounder rather than simply another technology stock. But while Microsoft's legacy businesses remain incredibly valuable, investors are now focused on what could become its biggest growth opportunity in years. Artificial intelligence. CEO Satya Nadella has repeatedly described generative AI as one of the most significant changes to computing in decades. That is a bold statement coming from someone who has already overseen major transitions involving cloud computing, enterprise software, and digital transformation. More importantly, Microsoft has backed those words with enormous investments. Rather than waiting for the AI revolution to mature, Microsoft has positioned itself at nearly every important layer of the technology stack. Its Azure cloud platform provides the computing infrastructure businesses need to develop and deploy AI applications. Its productivity software is embedding AI capabilities that improve workplace efficiency. Its enterprise software increasingly integrates intelligent automation. And its strategic partnership with Anthropic, announced in 2025, further strengthened Microsoft's position in advanced artificial intelligence. That partnership expanded Microsoft's AI ecosystem while reinforcing its commitment to remaining at the forefront of enterprise AI adoption. Why does this matter? Because AI is creating demand that extends far beyond chatbots. Businesses want automation. They want intelligent data analysis. They want AI-assisted software development. They want enhanced cybersecurity. They want productivity gains across every department. Delivering those capabilities requires enormous computing power. That demand directly benefits Azure. Cloud computing and artificial intelligence are becoming increasingly connected. Companies deploying advanced AI applications need scalable cloud infrastructure capable of handling massive computational workloads. Microsoft already owns one of the world's largest cloud platforms. As AI adoption accelerates, Azure becomes an even more valuable strategic asset. Management has acknowledged that demand for cloud services currently exceeds available supply in certain areas. Think about that for a moment. One of the world's largest technology companies is facing more customer demand than it can immediately satisfy. That is not the kind of challenge most businesses complain about. It also demonstrates just how rapidly enterprise AI adoption is expanding. Of course, scaling cloud infrastructure requires enormous capital investment. Microsoft has been spending aggressively on data centers, networking equipment, specialized AI hardware, and cloud capacity. Some investors initially worried those investments might pressure profitability, but recent financial performance has largely challenged that concern. Despite elevated AI spending, Microsoft has continued delivering strong revenue growth alongside healthy operating margins. That combination is particularly impressive. Many companies pursuing aggressive expansion sacrifice profitability. Microsoft has largely managed to do both, grow rapidly while remaining exceptionally profitable. Another major strength is diversification. If personal computer sales slow temporarily, Microsoft still benefits from cloud computing. If enterprise software experiences modest pressure, Azure may continue growing. Gaming, cybersecurity, business applications, developer tools, and advertising each contribute additional revenue streams. Few companies possess such a balanced collection of high-quality businesses. This diversification also makes Microsoft attractive during uncertain economic periods. Rather than relying on one single growth engine, the company benefits from multiple long-term trends simultaneously. Cloud migration, artificial intelligence, enterprise digital transformation, cybersecurity, business productivity, software development, data analytics. Each of these markets is expected to expand over the coming years, giving Microsoft numerous opportunities to continue compounding earnings. Income investors should also appreciate another often overlooked characteristic. Microsoft has become an aggressive dividend grower. Although its dividend yield may not appear especially high compared to traditional income stocks, consistent dividend increases combined with strong earnings growth create an attractive combination for long-term shareholders. Meanwhile, the company's balance sheet remains among the strongest in corporate America. Its enormous cash position provides flexibility to invest during downturns, pursue strategic acquisitions, repurchase shares, increase dividends, and continue funding cutting-edge AI development without placing excessive strain on its finances. Financial strength becomes a competitive advantage during uncertain markets. Companies with weaker balance sheets often pull back on investment exactly when opportunities emerge. Microsoft has the resources to continue investing aggressively while competitors become more cautious. Wall Street clearly recognizes these advantages. Microsoft currently carries an extraordinary 53 buy ratings, 3 hold ratings, and 0 sell ratings. That level of analyst conviction reflects confidence in the company's long-term strategy. Analysts continue highlighting Microsoft's diversified business model, leadership in enterprise software, cloud computing strength, AI investments, loyal customer base, robust cash generation, and exceptionally strong balance sheet. Some market participants have questioned whether Microsoft's substantial AI spending could eventually become excessive. Those concerns helped create periods of volatility over the past year. However, many analysts believe those fears have been overstated because Microsoft's revenue growth and profit margins continue demonstrating that the investments are generating meaningful business value. In other words, management is not spending aggressively simply to chase headlines. It is investing because customer demand continues expanding. That distinction is important. Technology history is filled with companies that missed major platform shifts because they invested too slowly. Microsoft appears determined not to repeat that mistake. Instead, it is positioning itself to lead the next generation of enterprise computing. When you combine decades of customer trust, one of the world's largest software ecosystems, industry-leading cloud infrastructure, artificial intelligence leadership, enormous financial resources, recurring enterprise revenue, and disciplined management, you get a company that remains remarkably well-positioned for long-term success. That doesn't guarantee the stock will move higher every quarter. No company is immune to market corrections. Valuation always matters. Macroeconomic conditions can influence even the strongest businesses. But for investors with a multi-year perspective, Microsoft continues checking nearly every box associated with long-term wealth creation. It generates consistent cash flow. It invests for future growth. It adapts to technological change. It rewards shareholders. And perhaps most importantly, it continues strengthening its competitive moat while many competitors struggle simply to keep pace. If you're looking for a stock capable of participating in the AI revolution while also offering the stability of one of the world's greatest businesses, Microsoft deserves serious consideration. Sometimes the best investment is not the newest company. It's the one that has repeatedly proven its ability to reinvent itself while remaining essential to millions of customers around the world. Those businesses often create extraordinary shareholder value over decades, not just market cycles. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now we'd love to hear from you. Which of these three businesses do you believe has the strongest long-term competitive advantage? Is it Trimble's growing leadership in industrial digitization, Wynn Resorts' portfolio of world-class luxury destinations, or Microsoft's expanding artificial intelligence and cloud ecosystem? Share your thoughts in the comments below because we'd love to hear your investing perspective. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.